Who founded High Rock in 2010. We started our private client wealth management division in 2015. If you're interested in learning more about us, visit our website at www.highrockcapital.ca. Well, the month of May started off for me. I was in Vancouver visiting clients, which was a very enjoyable experience. And let's talk a little bit about what happened in financial markets. Everything was better than it was in April, so that's good news. Most balanced portfolios were up nicely. Gold continues to lead, although it's come off its highs. Equity markets up across the globe, and preferred shares and even Canadian equities, and to a small degree, Canadian bonds were better. So, Paul, not a bad month for financial markets in May.
Yeah, and I saw one headline, I think, on Saturday morning in the financial press saying, thank God, May 31st month end was a major reversal in the US equity markets because they were down rather substantially on the day. And it still would have been a positive month, but they were down substantially on the day and rallied back in the afternoon substantially. So it was a good way to end the month.
Yeah, everybody likes to see their portfolios a little higher than the previous month, that's for sure. And speaking of that, we like to show comparisons for balanced portfolios, and we get our friends at Morningstar, the people who monitor thousands of mutual funds and ETFs, to help us with how, in general, balanced portfolios have been performing. And certainly year to date, they are higher. I think if most of our clients look at their monthly or year to date, I should say, they would find that they're probably slightly better than the Morningstar averages. So again, we're always here to have those conversations with our clients, and equally as important is the risk factors. We want to make sure that everybody is comfortable with the strategy they have and the risk involved in that portfolio strategy. We do monitor all your portfolios very closely, and if ever you wish to see how your portfolio has performed over time relative to the risk that we're taking, we are always happy to present that to you individually. And because everybody's portfolio is somewhat different, again, depending on how long you've been with us, what your strategy is. But we, in general, believe that our risk taken is slightly better than the average, and that improves clients' portfolios returns as a function of that risk. So again, we're happy to have these conversations with you at any time. Please reach out if you want to go into more detail with regards to your own portfolio. Paul, any comments that you want to make about the risk factors? I know you've been taking some risk off the table lately. Maybe you want to talk about that as we move forward.
Yeah, I would say the first thing is this slide we're looking at and the previous slide, just to be clear, these are not your individual performance metrics or risk metrics. These are just massive aggregation of different funds that Morningstar does. So yes, we obviously focus on what you see on this chart here, which is a Sharpe ratio, which is effectively the amount of return you're taking per unit of risk, and the standard deviation is the risk. And we all want to try and make as high a return as we can while taking the lowest amount of risk. So that's something we have always focused on at High Rock. And some of the ways we do that is through analysis and trying to find securities or sectors in the market that will outperform other sectors, i.e. will have a higher return per unit of risk, or the amount of risk we're taking. So
And if I can
Maybe,
just throw in there, Paul, just for a sec,
yeah,
we also look for areas that are not necessarily correlated to stock markets or bond markets. We do find asset classes that are not necessarily, as I said, correlated, which actually helps in many cases to bring that risk factor down. Correct?
yeah, that's a great point. We try to find uh, sectors in the market that have a low correlation to other sectors. So absolutely, that's a very important and a good point to make, Scott.
And
So
and and yeah,
maybe I'll
sorry,
talk
go ahead.
more about, as we go through the models, I'll talk more about some of the ways that we are just fine tuning our risk right now.
Perfect. And yeah, then and that comes down to our partial tactical approach to to some of the more active situations that you take on. So hang on while we move forward. If you want to talk about the high yield and preferred share mandates, this is your moment.
Okay, my moment to shine. So high yield, we'll start with that because it's very short, and we sent out the monthly update to our high yield investors yesterday, and there's really not a lot to add. And we've been not cautioning, but letting our investors in that mandate know that we think we've had, without going into detail or stating the number, we've had, a really good 3 years in this mandate. And a lot of it came from our pretty major overweight in energy. A lot of those energy bonds now have come to fruition, i.e., gone from distressed positions or stressed positions to back to fair value or par. When par in a bond is 100 cents on the dollar, $1, $100, however you look at it. So moving forward, I think we're going to have low volatility in the portfolio, but we won't see the same capital gains that we saw when bonds went from, say, 70 cents on the dollar to 100 cents on the dollar. But what we will see is stability and the coupon or interest income that the bonds pay us. So that's kind of what we've seen year to date so far, and certainly across the month of May in the high yield mandate. Preferred share mandate, certainly a lot more topical and interesting, and we've been reasonably active, and some of it just even yesterday and today, being June 3rd and 4th. So as many people know, and I've said before, preferred shares are, in my opinion, and without a doubt, the most complex cash security instrument in the country. And there's a reason why investment advisors across this country have had their eyes gouged out by these things, because they are complex and they require a lot of modeling to figure out what valuation is. They got hit very hard back in August, September, October of 2023. We did start this mandate in early November. We were about 2 weeks late by the time money rolled in, but nothing we could do about that. We didn't catch the absolute bottom. What we did do is catch a great move. And as we did that, we also began taking a lot more risk in bank preferred shares, which we had not done previously in 2017 when we last did a preferred share mandate for one individual client. Now, the banks, this is kind of interesting. The banks, most of them are in a surplus regulatory capital position, and they've been redeeming. These rate resets come up for redemption every 5 years, and the ones that are coming up have come up lately, year to date, and about to come up more. The banks have been redeeming them or taking them out of the market, and there's been several $billion that's been taken out of the market by the banks. And one of the reasons is because I think there are a few reasons, and I should wrap this up, but it's all got to do with regulatory capital. There's a better way better mousetrap for the banks to issue regulatory capital. And they also believe that the regulator does not want the banks to have these preferred shares outstanding, because retail investors through the investment advisor network have been hammered on these things. They've been very, very volatile. And as I said, they're a complex instrument. And I do not think the regulator wants the banks to have them outstanding. So we've got in the preferred share mandate, one that's coming up for July 31st. I'm sure we're going to hear in about 10 to 15 days whether it will be called. We have every confidence it will be. And then that we've got other ones beyond that in November and January. So we've had a big bet in there, and it's gone quite well, knock on wood, year to date. We are also rolling out of some of our rate resets, which are more of a floating rate note. The bank should meet, well, it does meet tomorrow morning. If they start cutting rates, and if the economy is weakening faster than the market thinks, some of these rate resets have the potential to weaken off. Now, a lot of money has been, a lot of preferreds have already been taken out. As I said, billions of dollars have been taken out of the market already, and there's probably more to come. So some of that money needs to go somewhere. I think in 5 years, Scott, the preferred share market won't even exist. It'll be gone. So we're trying to fine tune some of our risk in that mandate, and I'll talk more about it, what we're doing specifically in the balance mandates in the preferred share side. So sorry, that was a long process, but it's very important.
Yeah, and it's fascinating how we've been able to capture the upside of this in such a short period of time. But that's a short period of time for one particular asset class. Our job for our clients is to manage their long-term goals by finding good portfolio growth, and as Paul mentioned earlier, taking as little risk as possible to get that growth. Of course, it's always fine-tuned by the very specific needs of our clients and their long-term goals. So we encourage our clients to continue to stay in touch with us and continually update us on their goals, and so that we can continue to create the most appropriate strategies as we move forward. So let's talk a little bit about the global equity strategy, and it's very little. We have been rebalancing as clients need cash, taking sales as equity markets have been higher. New cash that comes in, we're being patient with. We look for a pullback in equity markets at some point in time over the next 3 to 6 months to put some of that money to work. So please, if you have new money coming in, you may be a little underinvested in your global equity mandate, but or model. If you're patient, we'll get much better pricing as we put that money to work. Paul, talk about the tactical strategy, if you will.
Okay, tactical, just some items across the month of May. We had a very small tag end of Auto Canada stock, which we sold during the month of May. Now, one trade we did do, which was a bit more of a major trade, and we're still in the process of executing, is we sold our largest position within the tactical model, which was a Source Energy bond. And this is a bond that was, we considered it equity exposure, equity risk, to be conservative, even though it was a bond, a high yield, or at the time, distressed bond. It's a company I know quite well. I've been invested in this thing for 7 or 8 years, and I've got a good relationship with the CFO. So I've been close to it. This bond was a phenomenal trade for us. It was, as the title says, very tactical. We bought this bond. I think the average cost for most of our clients who were in was somewhere around 38, 40 cents, and then it paid us. At the time we bought it, it was a cash yield of like 25%. We bought some at 25 cents and 52 cents, I believe. And so it was a phenomenal interest income or yield when we bought it. And then we just sold it at par. So, we more than tripled our money over the last 3 years we've owned this thing. It's been a great trade, but something changed. And that was the first quarter. They performed extremely well, but it has an extremely strong outlook. So I've never seen two things happen, or three things. They put in a record quarter. Their outlook is super strong. And the third thing that happened was this company has never traded at as low a valuation as it is today. So we sold the bond, and we're in the process of buying the stock of this company. So that is an ongoing process, and this bond comes due in March 2025, and I have every reason to believe that it will get refinanced. And I think when it does, the stock will shoot higher. There were some fast money hedge funds that have been selling the stock over the past month, and still appear to be doing so even today as we speak. That's about it for the tactical model, Scott. Fixed income. Yeah. So as we mentioned on the last call, and even just earlier on this call, our fixed income model, the highlight in there is the preferred share portion, which we hold a pretty large overweight in. Now, for our fixed income balanced investors, the preferred shares that we own and are overweight are these three bank preferred shares, which I spoke about earlier. Two of them, there's one commerce.pr.o and td.pf.b as in Bob, both come up for redemption on July 31st. And again, we have every reason to believe that both banks will redeem those. So where we bought, the TD one we bought last November, and that's been a phenomenal trade. I think, once it's all said and done, we picked up, we'll pick up three dividends on it. But even just on a price basis, I think we're up, what are we up, like 35% plus, 3 dividends. The Commerce O we bought more recently, at $24. If redeemed, it'll be redeemed at 25. Now it's only a 4% price gain, with one dividend coming, but it's over a very short period of time. So if you analyze that, you're looking at more like a 24% over a 6-week period. So, and that'll bring us back down there, depending on the model that you're in, the model of the model. That'll bring us back down much closer to our ideal preferred share weight. We'll still have one bank pref left out, which is BMO W, and that BMO W is up for redemption in November. So we will keep that as it is. High yield was again, going back to the high yield special mandate, very stable. Government bonds, as you showed earlier, Scott, added some value, and investment grade, which trade very closely in correlation to government bonds, did much the same. We added one high yield bond, which was one we used to own up until last fall, and the issuer came back. I had a one-on-one with the issuer, the CFO, who I know, and I quite like this company. It's got a high-class problem with arguably too much cash flow. So that's it for fixed income.
Excellent. Well, thank you so much for that update. And I hope we haven't taken up too much of everybody's time today. So let's wrap her up and say, as always, thanks for taking the time out of your busy schedules to tune in. We'll be back with our next update at the beginning of July. Until then, this is Scott Tomlinson on behalf of my colleagues Paul and Diane. We want to wish you all the best for the month of June.